Okay, we're gonna get started because even though we said it was gonna be a quicker lecture, when we put together the slides, we ended up having a lot of things to say. If you got any emails from me, you're already on this list, but if you haven't, if you're your friend, just fill out that form. Other things okay, first, yeah, content today, including the email. Don't need to spend too much time on this. I apologize that there's no food today. I didn't have the bandwidth to plan that out, but I'm thinking next week we'll do Chipotle. So I'll send out in today's email or tomorrow's email recapping today's lecture, a form where you can submit your Chipotle order. As promised, we're doing live Q&A, anonymous, so you don't have to feel any pressure if you ask a stupid question, even though there are no such things as stupid questions. The links are up there. It's bli.do/tsig, and that will allow you to ask questions, and we'll see it up here on the computer screen. Our last lecture, we were planning on doing a recap of everything we covered in the course, trying to show you guys how the whole financial system kind of plays a role and how it all connects. But we were thinking we probably want to have an hour worth of content in that lecture. So we want to open it up to you guys, ask, what do you guys want to see? What questions do you have? What things do you think we haven't covered that you would like to see covered? And you can leave a comment in the exit survey at the end of this lecture. Homeworks. We had promised it in the first lecture and we haven't delivered on it. And honestly, I don't know if anyone's really going to do them. They're not really homeworks in like the sense that you have to submit them and I'm going to grade them. They're really just ways for you to work through a lot of the examples that we talk about. Building an income statement, building three statements, connecting them, figuring out how leverage works, all these things. They're really useful assignments that we can create. Just by a show of hands, who would be interested in seeing these kinds of materials? Who would like actually find use out of them? Okay, we got two. Raise them high. Okay, so maybe I'll spend some time doing that. And also the little textbook of finance, still working on it. Takes a lot of time. I anticipate around the end of the semester, maybe after winter break, hopefully in time for any sophomores recruiting. And yes, I'm being intentionally non-committal. I just don't really know. I can't predict what my plate is going to look like in December. Okay, any questions before we jump into content? Okay, so first we're going to start off by defining a hedge fund. And
we're going to go back in history a little bit and look at the first ever hedge fund founded by A.W. Jones in 1949. A hedge fund basically has two key ingredients. First part of it is leverage. Kind of like how Archimedes said, if you need a long enough lever, I can move the world. In finance, your lever is debt. And with enough leverage, you could really achieve really high returns. The second part is short selling, which we'll get into more further. But all you need to know is this is the basic building block of a hedge fund.
Yeah. And that initial definition has expanded a lot. If you ask 20 people, you will probably get 22 answers. These aren't actual quotes from these people, even though I wish I could interview them. But generally, like these are some things that people might say, throw around some terms that try and define what a hedge fund is. We don't think it's very useful, so we kind of have our own definition. And yeah, Jason's not here today. He has a midterm tomorrow that he's in trouble for, so he's out there studying. But these are generally the 5 things that we think really structurally define a hedge fund. The first is investment focus. So you're primarily investing in those liquid markets. You're not investing in private companies and private debt. Though some hedge funds do this. And those are typically multi-strat hedge funds. You have names like Tiger Global, Farallon. Those will invest in private markets and private credit and all of these other avenues. Regulatory-wise, they're not as tightly regulated by the SEC, and they're open to accredited investors. And again, accredited investors are anyone who I think owns or earns over $200K a year or has a net worth of over $1 million, as defined by the SEC. And that pretty much the SEC thinks you're smart enough to not make stupid decisions with your money. And today I actually read an article about how some congressman has proposed a bill that would allow all of us to invest in hedge funds by taking a test called like a sophisticated investor test. Though people have large questions about how that would work. Third is an investment strategy. There's no real strategy definition of a hedge fund. They kind of do anything, everything across the whole gamut of strategies. And it doesn't even have to be a hedge fund where you hedge out risk. Though typically this is their goal. Risk-wise, again, they can be very risky, very little risk. Hedge funds blow up all the time. We'll go over a couple of those examples. But generally, they try and reduce market risk. So that means have lower volatility than the market. And the last is a fund structure. This is probably the most, like every hedge fund that is out there has this fund structure. So it's like the easiest litmus test. They are usually domiciled in one of those like Cayman Islands, British Virgin Islands, Singapore. They have onshore, offshore feeders, a fund management company, performance and management fees, all of this legal stuff. Again, we don't find it particularly interesting. We can present about it if you are interested in how these hedge funds are actually set up. And we can do that in the last lecture if you guys ask for it. We're going to move into a couple big concepts before we get there. Any questions about, maybe you've heard of a hedge fund and you're curious whether it fits our definition. And again, there's exceptions to every one of those rules. Okay, cool. So the first, as George said, leverage. We see leverage as, you're increasing the volatility of your returns. So in this graph down here, you assume 10% on the upside case, annual growth, 2% in the base case, and minus 5% in the down case. And over 3 years with a leverage of 2, again, I'll get into what all these terms mean. This is what your returns would look like without leverage and with leverage. And these are returns on your equity portion. So if anyone remembers when we talked about the leveraged buyout, how private equity funds will use a large amount of leverage and a proportional gain, like a 10% gain in the company's value could actually be a 50% gain on the equity portion of that value. So this is essentially allowing hedge funds to multiply their returns. And this simple formula here, return with leverage is equal to return without leverage times the leverage ratio minus the leverage ratio minus 1, allows you to calculate those returns, including leverage. And there's 2 terms here that are probably important. The leverage ratio, which is total assets over equity. So if you have a fund that has $50 million in equity, so if that equity is coming from outside investors, and you have 50 million coming in from a bank, that is your leverage. Your leverage ratio is your total assets, which is your equity plus debt. So that's 100 over equity, which is 50. So you have a 2x leverage ratio. Terms of leverage is just that quantity minus 1. So it means for every dollar of equity I have, how many dollars of debt do I have? So in that previous example, that's just 50 over 50, that's 1. And handily, it's also the leverage ratio minus 1. So that means for every $50 or $100 in equity I get from investors, I'm taking out $100 in a loan from a bank. And again, you can see that it enhances your upside scenarios, but it also hurts you on the downside because you have to pay off this debt. This model doesn't include the cost of leverage. So when you take out a loan from a bank, you have to pay interest on that debt. There's also minimum capital requirements, all these other factors that you have to consider. But this might be an exercise for you guys. Can you derive the returns formula if you included leverage? And what would this kind of look like? Would it hurt more in the downside case, hurt more in the upside case? How does it go across the spectrum of returns? So the way a hedge fund typically gets money is they have this thing called a margin account. And I think this probably describes it better. But generally, I'll go to this example. So in the initial case, let's say you put up $50,000 of your own capital and you took out a loan for $50,000. You have $100,000 invested. Let's say the stock moves down and the value of your portfolio is now $80,000. So you'd put up $50,000 in your own equity. That has been reduced to $30,000. A lot of times, when you receive margin from a bank, they have this ratio called the minimum margin requirement. That's an MMR in the bottom. And there's 2 ways to cover a margin call. And the actual structure of how this works is you usually have an account with the bank and you'll put money in and they'll take money out depending on your margin capital requirements. And that's kind of how you see the step function. That's supposed to represent the balance in your margin account. We're not going to get too much into this because it's a little complicated, but generally all you have to know is that there's 2 ways to cover a margin call. So this is pretty much when the bank will call you up and they'll say, hey, your investment lost money. We need you to post more collateral. And there's 2 ways to do this. The first is you can increase the percentage of equity by putting in more equity. So in that example, you take more money from investors and put it straight back into the investment, and that raises your equity as a percentage of total assets and allows you to hit that minimum margin requirement. Or the second option is to just sell off your, cut your losses essentially and reduce the total portfolio position size, which brings down that minimum margin requirement as well. And this sounds really conceptual and not important, but you can see this has probably been the single biggest driver of hedge fund blowups. And we're going to go through a story of Archegos, I don't know how to pronounce it, but pretty famous hedge fund turned into family office. It's actually a tiger cub. We'll get into what a tiger cub means in the future. But essentially what this fund strategy was, it's kind of funny. They would take really, really levered and really, really concentrated bets on 4 technology stocks. And they use this financial product called a total return swap, which means that instead of buying the stock and holding it in their brokerage account, they would essentially go to, let's say, Goldman Sachs and say, hey, you guys buy the stock. We'll pay you interest to hold the stock. And you just give me whatever the returns are. So if the stock moves up $10, you just pay me $10. If it moves down $10, you give me $10. And you might be thinking, what is the point of doing this? And honestly, it's just a way of getting implicit leverage, because now instead of buying the stock for $100, I can just pay Goldman Sachs $10 a month to buy that amount of stock. I hope that makes sense. Oh yeah, here, I have a graph. So let's say the underlying asset, let's say this is Apple stock. Bank A is the person who is the payer of the, or receiver of this total return, sorry, payer of the total return swap. So Bank B, think of that as Archegos in this case. They will pay Bank A a certain interest rate for Bank A to hold this asset on their balance sheet. And in return, Bank A will pay the hedge fund, in this case Bank B, the total return of the underlying assets. So all the cash flows that come to Bank A will just be transferred to Bank B. And so you can see how concentrated Archegos' total return swaps were. These were their top 4 positions. And as a share of their portfolio, 90% of their portfolio was concentrated in 4 positions. And if you have read any book on investing, they tell you, diversify your risk. And that is very true, especially when your risks are really, really levered like Archegos' was. So, they were successful for about a year. And they had rapid growth because these stocks were booming, and then suddenly these stocks start to fall, and the whole fund gets liquidated. And the funny part here is there were a bunch of banks. So because they're a family office, they don't have to report. Like if I go to Goldman Sachs, Morgan Stanley, and JP Morgan, and I say, can I enter this contract with each of you? Usually the banks, they're not stupid. They don't want to lose money. They'll check and make sure, okay, you're only doing this deal with me. You're not doing with like 5 other banks and being really levered and really irresponsible. But because they were a family office, they weren't subject to those reporting requirements. So what Billy Huang, who was the guy who ran Archegos, did was he entered into this contract with like a ton of different prime brokers. We'll get into what a prime broker is, but it's essentially that bank that will do that total return swap with you. And when he got margin called and they called him, they're like, hey, can you give us more collateral? Your stocks are declining. He couldn't do that. And so what happened was, I find this story hilarious, but the Jefferies CEO is on holiday in Turks and Caicos, and he's in the swimming pool. And he gets a call from like whoever's managing this client, and the client says, "Hey, like Archegos isn't answering their calls." And the guy literally goes like, "I'm going to get a margarita. By the time I'm back, I want all those positions liquidated." And so Jefferies actually walked away without too much of a loss. But as you can see here, Credit Suisse lost $5.5 billion. Morgan Stanley lost $900 million, all because this guy took these really levered bets, got margin called, and he couldn't post the collateral. So you can see how leverage can really blow up a hedge fund. And this also happened in 2008, right? You have credit default swaps, which have implicit leverage because they allow multiple parties to bet on the default risk of a security, even if they don't own it. So there was this crazy quote, I think like more than the GDP of the entire world was traded in credit default swaps leading up to the 2008 crisis. And there's an even bigger hedge fund blow up known as long-term capital management, which is like, there's books written about it. What's the book called?
When Genius Failed.
When Genius Failed. Thank you, Ria. But yeah, you can read here, they were levered at 25x. So for net asset value at $4 billion, the total portfolio was $100 billion. And they had a bunch of bets that started to go sour, and they couldn't cover their margin calls, so they had to liquidate the positions. And this cascades the effect because, for example, in the Archegos example, if Jefferies suddenly sold those 4 technology stocks, the hundreds of millions of dollars of stocks that they were holding, that stock price goes down. Now, UBS says, okay, we also need to sell. Stock goes down further. One of those stocks was Paramount Global. If you look up their stock price, they were trading at, I think, like $100. And then they crashed to $10, and they haven't gotten higher since this whole debacle happened. Okay. That was a lot. Any questions about that? Sorry, let me check. What is the definition of liquidating a fund? Okay, liquidating a fund is essentially when you return all capital to your outside investors. So if I took money from 5 of you guys, I invested it, and you guys demand your money back, I have to give you the money back. We'll get into exactly how redemption notices, lockups, and all of that stuff works. But that pretty much means you close your fund down, you lost a bunch of money, you either lost investors' money or you returned that money, all that kind of stuff.
Most importantly, you need to do what's called a fire sale. Right?
Yes.
Because you need to get rid of all your positions in the market. So you'll often be forced to sell your position at a steep discount, which would only make your situation worse.
Yeah, and especially when you have illiquid bets. So for example, if you own a house, you can't sell a house in a day, right? You can sell your Apple stock in a day. You might have some slippage on the way down, but you can't sell a house in a day. But if you have to, and you have to get that money out in a day, you'll probably sell it at a much worse price than you could get if you waited. And that's the whole notion of a fire sale. Okay, hedge fund strategies allow themselves to have different levels of leverage. And you can think about what causes this discrepancy. So when your return profile is very high in volatility, which means it's kind of random and you really can't predict it, you can't take on that much leverage because on the downside case, if you get margin called, you have to be able to post collateral and cover that margin call. But credit, for example, like if you're betting on US T-bonds, there's not much volatility there. You could probably lever up that bet and have more leverage in your hedge fund. Okay. Yes.
Now, short selling, another important ingredient to an actual hedge fund. It's the reverse of buy low, sell high. So you sell high and then wait for the price to drop, and then you buy low. And I think you all kind of know the mechanism of shorting. You can do this via different derivatives as well. So not just borrowing a stock and returning it later. You could do this with put options, futures, and also total return swaps, like Sid mentioned. We won't go into too much detail today, but you can see a return payoff diagram on the top right corner. We also want to clarify what is a hedge fund's gross versus net exposure. So a hedge fund has a long book and a short book. If you sum up the absolute value of the two books, you get your gross exposure. And this is a pretty good reflection of how much leverage you have in the entire fund. But if you only sum up the long book, you subtract the short book, then you get what's known as net exposure. And this is a good reflector of how much bias or how much exposure you have to the market. I guess, so the lower the net exposure, the more market neutral you are. Meaning that if the market goes up by, let's say 100% or down by 100%, you won't be impacted that much because your gains on the long position should offset your losses on the short position. Does that make sense? So finally, you'll see different long versus short exposures. And can anyone guess what is the typical net exposure or gross exposure of a hedge fund? Anyone? We'll just tell you very quickly since we're short on time. I'll be the one highlighting the box. So typically you want to have minimum net exposure to really restrict market exposure, but run high gross exposure to have high leverage, generate higher returns. And we'll get into how exactly that works later.
Just a quick note there, sorry. A lot of funds are typically long biased, which means that their net exposure is positive. So maybe they're 50% exposed to the market, but the typical hedge fund is supposed to be hedging out all market risk. And that is the whole case where you have zero net exposure, but a higher gross exposure to compensate them, to show leverage.
So as we mentioned, short selling is kind of the opposite of longing the stock, right? And this comes with a pretty important caveat. That is, your losses on a short position could be unlimited. Take the case of GameStop, right? As you might recall, a couple of years ago, there's a bunch of people on Reddit that were going to be like, let's all buy GameStop all together. It's going to go to the moon. Well, if you bought the GameStop, you're in a good position. But if you happen to be one of the hedge fund managers that shorted GameStop, then you're in a bad spot because your losses could be unlimited. This is what happened to a famous long-short equity fund called Melvin Capital. Take a look at their returns over time, and the headline just a couple months later. Eventually, they had to close down because they lost almost 50% of their AUM on GameStop alone. And what this GameStop saga really highlights is the implicit risk in liquidity when you have a short position, right? Imagine if you're shorting a name that's not very well known, there isn't a lot of people trading it, then not only are the costs of borrowing the stock to actually short it higher, but also when you want to close out your position, or if you're caught in a short squeeze, it'll be much more difficult for you to get out of it.
Can you go back one slide? Yeah. Yeah, there's no question. I think maybe okay. Yeah, you can go. Also, the slides will be sent in an email after.
Yeah.
But yeah, you can continue.
All right, good.
Okay. Oh yeah. So not last. There's a couple more concepts. Spreads. When we say the word spread, it is just finance lingo for the difference between two things. So if something's trading at $60 and you think it should be trading at $40, your spread is 20. Very, very simple. LIBOR and SOFR. So LIBOR is the London Interbank Offering Rate. It used to be the old benchmark for which floating interest rate loans were benchmarked to, but now the Federal Reserve of New York maintains this thing called the secured overnight financing rate. And essentially what that means is if you take out a loan from a bank and they tell you about floating interest rate, that means it's not fixed in time. Instead of paying 4% every year for the next 30 years, you're paying SOFR plus 50 bips, for example. And that means whatever the SOFR is, take that, add 0.5%, and that is your interest rate. And bonds typically trade at increasing spreads to these SOFR. I mean, for bonds, usually use the US Treasury as the benchmark. But as you go down and you move from investment grade to junk or high yield bonds, and you move from the lowest risk investments to the highest risk, those spreads typically widen. So there's this whole class of hedge funds that engage in high yield credit. And that essentially means they're looking at these so-called junk bonds and trying to figure out which ones are actually junk and which ones are probably safer than the market thinks. Delta is another term. It could also mean what spread means, like just a difference between two things. Also in finance, especially in options, delta is the change in your product with respect to one unit move in the underlying. So for example, a delta of 1 means that if the stock price moves up 1, your financial product also moves up 1. I think that's okay. There's also something called the bid-ask spread. So this is what an order book over here looks like, and that order book is essentially the market clearing price is in the center of the bids and the asks. And a market maker will buy something at $100 in this example and sell it at $101 and collect that spread between the bid ask. And typically for really liquid names, this bid ask spread is very low, right? Because it's a very competitive market. A lot of market makers are trying to make this market clear. And so that bid ask spread might be like 0.005 cents or something like ridiculously small. And typically for less liquid things, that spread widens. And that also signifies to you how much liquidity is in that stock, how much volume is traded. As I was saying, for example, the AAA corporate bonds are here, and the high yield spread is over there, high yield B rated, and as you go up, those they typically move in a pattern, and they're just offset by a little bit, and that's that spread.
Yeah, just to clarify, AAA means these are the safest investment grade bonds that you can get, and then as the letters go down, they tend to be more risky.
Yeah, and you can see all that, like the different firms, like there's BB plus and like all these different things, different firms, different rating agencies have different letters for it or words for it, but they all mean the same thing essentially. Okay. I forgot what I was trying to say with this slide, but generally like the spread that you think of when you are trading stocks or you're doing fundamental equity analysis is the spread between the stock price and your intrinsic value. So if you calculate your intrinsic value to be, that bar, and you would get that through the DCFs that we covered in lecture 2, they would give you that notion of intrinsic value. If the stock is below that intrinsic value, maybe you think, okay, it's going to go back to that intrinsic value, you'd buy it. If it's above, maybe you think, okay, it's going to fall to the intrinsic value, you can sell it. There's a really famous investor named Seth Klarman who runs Valpost Group, which is a big fundamental value hedge fund. He popularized and wrote a book about this idea of margin of safety, which means, there's a lot of variance in what that intrinsic value can be. And so instead of buying it just when it falls below the intrinsic value, wait till it's really low. And that way, for sure, or as close to sure as you can, that you're not going to lose money on that bet. Okay.
So another major concept in hedge fund management is pair trading. And the big idea is you select companies in a way that neutrals out the market impact on your investment so that the only source of return that you get is stock picking or your skill. And we can illustrate what makes a good pair. Well, think of companies that have a presence in similar or adjacent sectors, for instance, aerospace, and you want to select industry, if you will, that's net zero or parallel efficient, where one company clearly benefits at the expense of other. So a very famous example will be Boeing and Airbus. We won't go through the detail of the thesis, but you could read it or check it out later. But imagine if you long Airbus and short Boeing. This is what your returns would have looked like from January 1st, 2021 until the present. So as we mentioned earlier, the whole point of doing this is neutraling out the market impact, right? So over the same time frame, we selected an index to represent the whole aerospace industry in America, which went up by 16.3%. This theoretically has nothing to do with the returns you would have realized on your pair trade, which is much higher at 26.7%. Now, you might think by doing this pair trade, right? If both companies do well, one will outperform the other, so you make money. If both companies suck, one will be hurt more than the other. You should have lower risks, but it's not necessarily true. It's heavily dependent on the time frame that you select. So when you compare the return on your investment against the risk, which we will presently define as standard deviation of returns, you see that if you just bought the index, it will give you a better risk-adjusted return. Now we'll clarify all these terms later. But again, in some scenarios, you could have higher risk-adjusted returns if you did a pair trade. For instance, we did Coca-Cola versus Pepsi for the same time period. And you see not only does your pair trade yield higher returns, but also lower standard deviation. So it's higher returns that's also safer. And, yeah, and moving on to arbitrage, probably one of the most important concepts in hedge fund management. So definition, it's just portfolio that costs you nothing in the present, but will yield a strictly greater than zero payoff in some future state. Or, in layman's term, risk-free profits. So this is one that Sid found a couple of days ago, which is really interesting. Yeah, are you betting on right now?
The spread's going way down.
Okay, well, someone took advantage of this arbitrage, right? But as you can see, the prices clearly aren't the same. So why does it exist? Well, let's think of basic economics, right? Let's say markets aren't efficient, arbitrage does exist. Then people like you in the room might want to take advantage of it. You will buy in a cheap market and sell in the more expensive market, right? Therefore, pushing prices one price up, one price down. They should theoretically converge, as you see in the top right corner. The shape of it is complex because of basic supply and demand curves. And as that happens, right, you force markets to become efficient. You force the price to reach equilibrium, and thereby the arbitrage opportunity is closed. So why isn't this happening in this case? Well, it breaks down, the efficient market hypothesis breaks down in these areas. Firstly, traders, yes, want to take advantage of the arbitrage, but often can't for a lot of reasons that have to do with market frictions. So there are trading costs, right? It doesn't cost me nothing to tell my broker to place an order for a stock or short a stock. There are also risk aversion behaviors among investors, and we'll get into that probably in the future lecture. What all of this means is that small deltas in the price may not be exploitable if you have these frictions. And additionally, you also have liquidity constraints and whatever. It'll make it very hard to execute arbitrage at the scale that you need to close the delta, right? So this means that the cheaper market won't become more expensive, and the more expensive one won't become cheaper. So arbitrage persists. I guess the question for you would be, how would you construct an arbitrage in the election markets? And what would be your maximum theoretical payoff? We'll just leave it to you as well.
And I think an interesting thing to note about the election market specifically, poly market, this one, the way it's settled is it's supposed to be completely decentralized. So essentially on the blockchain, you use these things called oracles, which tell you what outcome actually happened. So whether Donald Trump won or whether Kamala Harris won. And I guess the reason that this arbitrage opportunity exists, some people think, is because that's the probability that the market doesn't resolve the way you think it will. So that even, let's say, even if Kamala Harris won, all the people on the blockchain keep saying Donald Trump won. So that market would resolve to Donald Trump winning. And yeah, this I didn't realize George already covered in his slides. So I'll skip that. And yes,
okay. And then, right, we kind of alluded to this earlier. You don't want to just evaluate an investment based on the return generated, right? You also want to, kind of think about how much risk did you take to generate that return. So as we defined earlier, most people in finance define risks of an investment as the standard deviation of your returns. And but granted, not all volatility where standard deviation is bad, right? If let's say I buy a stock, the next day it goes up by 1,000,000%, I should be very happy with it. So you can make the case that hedge funds really only look at downside risk, right? Or scenarios in which you lost 100%. So that motivates two different formulations of like a risk-adjusted return. One is your Sharpe ratio, which is just the ratio between return and standard deviation. And the other is return divided by downside standard deviation only. The other thing that you need to know is what's known as beta or market exposure, where as we alluded to earlier, right, think of that net exposure of your fund. How exposed are you to market movements? A beta of 1 means you're more volatile than the market. So if the market goes up by 10%, your fund should go up by more than 10 and vice versa. And this has to do with the beta term in the capital asset pricing model. And you should, if you're interested in this, you should take more classes on this at Princeton. moving on. And then there's also the concept of drawdown, or some people refer to as the real risk in a portfolio, right? And drawdown is simply the biggest decline in your AUM from peak to trough. And this is kind of the real return that's actually realized in the market. And investors and LPs are super sensitive to drawdown. In the top right corner, you see what happened to LTCM in just a period of I think 8 months in which they sustained continued drawdowns. Not only did they lose most of their investors, they also just could not continue operating as a hedge fund. And lastly, so if beta is the correlation to market as a whole, you also have betas to different factors. Now think of factors as strategies are really easy to replicate in the market. So for instance, value is something that theoretically could be replicated by just buying the stocks are the most expensive by some financial metric, say P ratio, and shorting the top 100 stocks are the least overvalued. And you want to do this because, well, a lot of times hedge funds could have returns, high returns masquerading at as high beta exposure. Think of this, a famous example would be one called ARK investment run by Cathie Wood, who famously kind of went all in on Tesla, right? So yes, she did have great returns from maybe from 2019 to 2021, but she also took ridiculous amount of risk by doing that. So you want to compensate and evaluate hedge funds, again, based on their market and factor exposures. All of this means that there are very different, many different flavors to the common phraseology of beating the market. What does it actually mean to be a successful hedge fund? Well, one way of defining it would be to generate alpha, right? The antithesis to beta. And we define this as excess returns over all the little betas of your fund. So the beta to the market, beta to factor 1, 2, whatever. The example in the top right corner kind of shows the difference between this traditional definition of alpha, right, which is just excess returns over the market return, versus what we think is a much better definition of actual skill in investment management. The other way of evaluating hedge fund performance would be to look at absolute returns, right, or just the returns portion of it. Because some funds run a strategy that's super consistent and very difficult to benchmark using indices or factors. And one famous example would be Renaissance Technology that generated over 60% year-on-year return for a period of 20 years. And they run some really sophisticated quantitative methods, and they hire basically Nobel Prize-winning physicists. Some have said Renaissance Tech has the best physics department in the entire country. And lastly, you can also evaluate hedge fund performance on the basis of risk-return trade-off, right? So think of it as how much additional return have you achieved by taking on additional unit of risk.
Sorry. Yeah, 2 questions. Pair trading is essentially that structure of the Boeing, Airbus, Pepsi, Coke. It's when you take 2 assets that should be correlated or something and you exploit the difference between them. You try and isolate the specific factors in one that you think should outperform the other. And is there any situation where you wouldn't be able to liquidate a fund? Yes. So if your portfolio, you have $100 in the fund and it goes to 0, there's nothing to liquidate. You just lost all your money. Your investors walk away with nothing. But generally, like as you see things going down, investors will start calling you up. Famous scene in The Big Short when Michael Burry is getting a ton of calls because he's paying all these interest payments on his credit default swaps and he refuses to sell. We'll get into lockups and gains in a bit. But yeah, if your portfolio is worth 0 at the end of it, you can't liquidate anything. Yeah.
So yeah. Now you can plot risk and return of hedge fund on this plane. And the red line is 45-degree line, right? And you see hedge funds kind of have pretty high variance. They're scattered around, this low vol, but also decent return range. And crucially, your regular equity indices will have much higher volatility, but not the requisite level of return to really, justify for that. And lastly, private equity and venture capital are super high risk, but also, super high return.
Yeah, and generally, like the good places to be on this risk return plane are the top left, right? Because you have very little risk, very high return. The worst place to be is like where the Shanghai Composite is, like decent or like bottom right, I guess. Yeah. Okay, a lot of stuff. There are questions on the thing, but if anyone wants to ask a question, I was trying to keep it. We have 20 minutes to get through a lot of more stuff. Okay. Long short equity, bread and butter of hedge funds. We're covering this way more in depth in the next lecture, and this is what most investment clubs across the university do. They do stock picking or trying to identify good companies. Oh yeah, please.
So another very popular hedge fund strategy is global macro, and these are strategies that try to discern and capitalize on trends in global financial markets using a range of different instruments. So you could think of global macro strategies as one of two buckets, right? They either take a directional bet or they're market neutral. So if you take a directional bet, it could be something like you long dollar against euro because you expect the Fed to hike rates, or you long oil expecting OPEC to cut oil production. And the instruments I'll use are listed at the top right. And if you're operating on a market neutral strategy, right? So you're not betting on something will go up or down in value. You're instead betting on two things will converge in value. So questions that you may ask could be like how to compare yields across different instruments. How do you compare derivatives with the underlying? Yeah. Oh, question.
So with the macro strategies, if you're basing investments on like overall economic trends, how is that consistent with being market neutral against economic trends?
Well, yeah. So if you want to express a view on, let's say, labor or unemployment, then you're taking a directional bet. You're not necessarily doing something market neutral anymore.
Again, not all hedge funds are market neutral, right? A lot of them like to take these bets and they have the discretion to do that. The classic market neutral hedge fund wouldn't be taking those kinds of bets, right?
You could also do hedging, not in one single trade, right? So your position to one trade might offset another. So as a whole, your portfolio could be somewhat market neutral, even though individual trade positions are not. Skip nine futures.
Yeah, okay. Event driven, essentially anything that happens like corporate or market events that alter a company's fundamentals is what event driven hedge funds will try and take advantage of. Most classic example of this is merger arbitrage. So it's a well-documented effect that if a company agrees to buy another company, the acquirer's stock price will fall and the targets will appreciate to the deal price. There's a lot of risk with this, right? Like the deal could break and then the stock price falls, blah, 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 blah. This is a pretty easy strategy to replicate, right? Like on the announcement of a merger, buy the stock, wait for the merger to close, right? And so back in the day when there wasn't Bloomberg, this was a lot of like hard work. You had to keep calling up investment bankers and saying like, oh, like what do you think is going to happen? Like trying to anticipate what companies would be acquired. And over time, there's a whole page on Bloomberg now. You can literally just type in a command and it tells you all the mergers, what is trading at, predicted mergers, all those things. And so these systematic strategies can replicate the return profile of event-driven merger arb hedge funds. So this alpha has kind of been eroded over time. You can see that in this trend line. So something I find super cool is given the market's price after the merger is announced, you can back out the implied probability that the deal will fall or break. And if you think that the deal will break and the market's not pricing it in properly, you can even do reverse merger arbitrage. We'll get into all that stuff, but I think the example shows it best. So this is the day that Rogers is offered at $277 per share. You can see it goes up, right? So if you were able to predict that before, you could buy it before it went up. And then maybe you think, okay, like this deal is not going to go through. You can take a reverse merger arb and short the stock, thinking it's going to go down. Yeah, we might need to skip this. Okay. Actually, take it quick.
So big idea of capital structure arb is different pieces of a company's capital structure could be priced inefficiently relative to another. So probably the most popular strategy is convertible debt arbitrage. A convertible debt is basically a bond plus an options. So in theory, its price should be equal to the price of the bond plus the options, right? But you can try to see if that actually holds, and if it not, exploit that. Yes. Strategy very quickly. It's the topic that we know the least about, but very important nonetheless. Relatively speaking, they tend to always be market neutral and seek to profit from mispricings using statistical models to identify maybe correlations or mean reversion in asset prices. And again, there's some major buckets here. So one would be index arb. When you trade, right, the whole index, let's say S&P 500 against the underlying, so the 500 stocks in the index. Another will be volatility trading, mostly concerns options. So how, what's the implied volatility in the market versus the actual volatility in the market? And adjacent to these strategies are quantitative asset management that use factor models, which you'll learn about in many econ classes at Princeton.
Okay, yeah, other strats, activism we'll cover in a future lecture. We think it's one of the cooler ones, and yeah, infinite number of strategies that hedge funds can kind of take on. Okay, no questions. I'm gonna try and burn through these things because it's a little bit boring. But generally, hedge funds, just making investments doesn't make you money. You're not managing your own money, though the GP in a hedge fund, which is the person who actually manages the hedge fund. So this is like a GP, for example, might be Bridgewater, or it might be AQR or Tiger Management, whatever. They are called GPs, general partners, and generally they'll put up a large portion of their own money to align interests with the LPs. Those are limited partners. Those are the people who are actually investing in the fund. You'll hear GP and LP thrown around a lot, so it's important to know. Generally, there are two ways that GP will make revenue. The first is performance fee, so a percentage of the profits you make, generally around 20%, or back in the day, it used to be 20%. Management fee, it's just a straight percentage of the fund's AUM, regardless of the performance. And sometimes the performance fee is subject to this thing called a hurdle, which means we'll get into that. But here you can see the payoff, a GP's revenue, a hedge fund's revenue. The x-axis is the return that they make. So consider $100 million hedge fund, how much return, or $500 million, I forgot the exact number I put. But you can see that the 2 and 20 model is just a straight line. You start with an initial amount of money that comes from the 2% on your AUM. So in a $500 million fund, your 2% is $10 million. So even if you lose money, you're bringing in $2 million. This is to keep the lights on. As you start to make more money, you get 20% of all the profits that get realized. Some funds have a hurdle. So that means that at 8%, until you hit 8%, you do not get any performance or incentive fee. And until after you cross 8%, you'll start receiving 20%. Some of them even have this thing called the catch-up, which means that after 8%, we'll split it 50-50 until you get back up to what you were supposed to be under the 2 and 20 model, and then we'll split it 80-20 again. And you can see that fees have actually been falling over time, right? The average management fee and average incentive fee have both been falling. This is because of increased competition in the hedge fund space. Their LPs are able to demand more. Back in the day when there were very few hedge funds, they kind of were like, oh, you guys all want me, supply and demand, price goes up. Now there's a ton of hedge funds that do a whole bunch of different things. They have larger capacities. Those fees are going to continue to fall. These are other important notes. You can read these in your own time. I don't think there's anything I really need to talk about here. Okay, yeah. So you can see that there's two factors that really drive a fund's revenue. The first is their AUM, their assets under management. Essentially, how much money have they collected from investors? And also, how did they perform in a given year? And you can see that just increasing your AUM, even if you lose money, you'll start bringing in a lot of money. You're still bringing a decent amount of revenue. Even if you're losing 10% every year, you're still bringing in money. Obviously, people will get mad at you and start taking away their money and giving it to better hedge fund managers. So it's a very competitive game. But generally, the two things you want to do is, obviously increase your performance, but also increase your AUM. And so AUM and raising AUM and fundraising is a very important problem for a lot of hedge funds. They have whole teams dedicated to this. They'll usually try and match investor interests using different share classes. So, maybe they have an investor in Japan who wants to invest in their fund. They'll create a whole specific share class that, gives them back yen, accepts yen, and gives them back yen. There's different fees. If they're the first investor in the fund, maybe I'll give you less performance fee, less management fee. You can get a bigger share of the profits. Maybe from this share class, I only want to take 5 million. Minimum investment size from this share class, $50 million, all these different things. Again, starting a hedge fund is probably going to be really difficult. You have to get that initial capital. So similar to how venture capital will give, fledgling companies some money to get started, there's these people called seed investors, and it's called seeding a hedge fund. And what that means is they'll give you initial capital to invest with. They'll take reduced fees. They'll take a percentage of your revenue, and they'll also take equity in your company. And so the reasons that hedge fund managers will agree to this is it's kind of like a stamp of approval. Like, okay, this person trusts me enough to give me $50 million to invest. It also means that there's a critical mass in the fund, right? If I'm an investor in a fund and I'm their only investor, that means I bear 100% of the risk. If there are other investors, it's good for me. And there's a couple more nuances here that I kind of want to skip. Julian Robertson, you'll hear this name and the term Tiger Cub thrown around a lot. You can see Archegos is also on the list. That was a Tiger Cup. There's a bunch of like really, really big hedge funds here: Viking, Lone Pine, Tiger Global. These are essentially like the dream places to work for a lot of people. And essentially, this guy, Julian Robertson, he used to run a fund that closed in 2001, 2002 after the dot-com bubble. But after he was a billionaire, he gave a bunch of his employees like $25–30 million to go start their own hedge fund. And these have been wildly successful. Another thing that these hedge funds will do when they're starting off is sign on to a platform company. And what this means is the platform company will handle all of the back office work. So they'll take over the operational, legal, risk management, compliance, reporting, licenses to trade, all of that kind of stuff. And in return, the fund manager has a lower fixed cost, which means that they have a lower break even. Okay, multi-managers. I think we're good. Yeah. As George had mentioned, this is the arbitrage loop, right? And the whole idea here is that in an efficient market, if there's an arbitrage, then arbitrage will close. That is referred to as the capacity of a strategy. So if you participate in a market and you try and trade something, eventually you buy so much that, you know, if a stock is trading at $20, you believe it should be trading at $30, and you buy a lot of that stock, demand will, you know, push that stock price up. Eventually it'll hit that $30. And so this is referred to as the capacity of a strategy. So any spread that you're trying to exploit, any strategy you're trying to deploy, as you deploy more capital, the marginal gain on every dollar you invest gets lower and lower. And so there's a couple of reasons for this. The first is that, you know, when there's a lot of people doing a common strategy, for example, merger arbitrage, that spread is naturally smaller. And we saw that, right? When systematic methods can replicate a strategy, those returns will start to diminish. Also, when you deploy a lot of capital, if you're a $1 billion hedge fund and you're trading on a stock that has a market cap of $6 million, you can't deploy $1 billion into a $6 million stock. You know, you have capacity constraints. Also, when you buy a lot of a stock, there's something called slippage, right? If I want to buy $1 billion of a stock, I might be able to get 100 shares at $10 a share, 100 shares at $101 a share. Sorry, I'm not making sense here. But generally, as you buy more, the price will keep increasing and you'll keep buying. That's called slippage. So we'll go over break even of a hedge fund here. So running a hedge fund, as we already covered, is pretty expensive. You have all of these different costs. And regardless of performance, you need to keep your lights on, right? So you need to have a minimum AUM in order to be a hedge fund. And sorry. Okay, yeah. So this is an example. So imagine you're running a really small hedge fund. You have two portfolio managers. You're paying them each $400K base salary, not including bonus. And they have two analysts each at $200K annual salary. You pay $2 million to get all of your legal structures set up. You have audited tax expenses, et cetera, et cetera. Your yearly expenses are $2.4 million. With a 1.5% management fee, if you do the math, your break-even AUM is $160 million. So you need to have that minimum amount in order to sustain your hedge fund. And so what if your capacity for a strategy, what if your entire strategy is trading really like small penny stocks in the pharmaceutical space? Maybe each stock you can deploy $2 million, $3 million into. You can't deploy that much. But somehow you need to hit $160 million to break even, to have your team to be able to trade. What are you supposed to do? So it's a pretty big dilemma. And really smart people such as Ken Griffin kind of saw this as an issue, and they deployed this platform hybrid investment structure called multi-managers. And this is when you think of Citadel, Millennium, Point72, D.E. Shaw, all these big names that all of you guys have heard of. Those are multi-managers, also known as pod shops, etc. What they do is internally, they have teams, siloed pods, that's why they're called pods, of different PMs and their own analyst teams, and they'll allocate capital internally to each of those PMs. So if Citadel raises $1 billion from investors, they'll give each of their 1,000 or 100 PMs $10 million. This is pretty good for LPs, so to the investors to Citadel, and for a few reasons, right? Because PMs at these firms have really niche strategies that are diversified alpha streams. So you're probably the only person in the world doing this really niche strategy, and it's really uncorrelated with the entire market. So regardless of if the market goes down or up, you're delivering good returns. And yeah, so these are like pretty big names. You've heard of most of these probably. These are the firms that do multi-managers, or that are multi-managers. So a core problem for these multi-managers is retaining these good PMs. If you're a really good PM, why does it make sense for you to stay in this multi-manager structure when you can go and potentially start your own firm your own hedge fund, or maybe transition, and there's a lot of poaching between Citadel and Millennium. And points number two, they'll keep taking each other's PMs, trying to offer a better deal to each of them. So there's a problem that, if you think about it, kind of makes sense, and this is called netting. So consider a very simple multi-manager where there's two fund managers. Manager A, they each get allocated $100 million. Manager A is up 20% on $100 million, so they made $20 million. Manager B loses 20% that year. So at the fund level, let's say it's at the Citadel level, they made $0, right? One guy lost 20 million, one guy made 20 million, that nets out to zero. But manager A is sitting and he's like, hey, I brought in $20 million. Where's my incentive fee? Where's my 20%? Where's my $4 million? So multi-managers have to solve this issue. This is something called netting risk. So there's two ways. Either Citadel says, okay, yeah, sorry, like you actually made a lot of money. We'll pay you out of our own pocket. And that is like the LP friendly way, right? Because the LP doesn't have to worry about that. More common, and actually what happens in the real world, is something called pass-through expenses. So even as an LP, you gave Citadel $200 million. They gave it to two of their own internal PMs. You got back $0. They made no money at the gross level. At the net level, though, Citadel had to pay manager A $4 million in order to keep him happy and not have him leave. So the investor loses 2% in the case where they grossed nothing. Does that make sense? Okay. Multi-managers are wildly successful, and we'll go into a couple reasons why. So you can see here on like the risk return plane that we showed earlier, the largest multi-managers are up here, right? $10 billion plus. That is objectively the best, right? It's the lowest volatility and the highest return. Even all the smaller ones are pretty good, right? They're all really high, like decent returns, but also extremely low volatility. And that's because if you have 100 PMs, each doing their own tiny little strategy in completely different markets, who have no knowledge of what the other PM is doing, they're kind of just trading in a silo, they're all very uncorrelated. And when things are uncorrelated, you lower your overall risk. So the inflow, the AUM compounded annual growth rate to multi-manager funds versus the remainder of like other hedge funds, I mean, you can see they've been growing at a 20% CAGR over like a 6-year period. That's really explosive growth. And that's why those are the big names right now, like the Citadel, Millenniums, all of those. This is the pass-through expense thing. So really the best fund managers know that they're the best. So they take a higher fee. They pass through a lot more expenses. This isn't that important, but I think this is the coolest part. So look at their correlation to equities here. Over a 5-year period, they're extremely low correlation to equities. So if you're an allocator, you're a Princo, you already have a ton of hedge fund managers doing long short equity. You don't really care about another new guy who's like pretty good at doing long short equity because you already have a lot of exposure to that market. But a multi-manager can come along and say, hey, look, over the past 3 years, we're actually negatively correlated to equities. So that means when you lose money on all of your other investors, we actually make money, right? That is a really good value proposition because allocators want steady increases in their in returns, right? And you can see the returns aren't terrible, they're not great, but you can see that their volatility, their risk is much lower. And that comes from stacking together all of these diversified, uncorrelated alpha streams and returning them to investors in a good way.
Wait, so one thing to add. Additionally, the pod shops have centralized risk management systems,
Yeah.
which means, right? Remember when we said not all hedge funds are market neutral, but the true definition of a hedge fund should be market neutral? At a pod shop, let's say your pod isn't market neutral. Well, the risk management team will neutral out your pod. So if you can still generate returns after all the beta risks you're taking have been neutralized out, then they'll not fire you and compensate you for the work that you've done. And that's another reason why they have such low volatility compared to other hedge funds.
Yeah. The biggest trouble in running the Citadels and Millenniums is how do you retain talent, right? If Millennium suddenly starts offering 1% more like incentive fee, performance fee to all of their PMs, then every PM in Citadel is like, look, I can do my exact same strategy at Millennium and make 1% more. That is like a really easy decision for a lot of these people to make. And of course, you're subject to like these really long non-competes. I know one person who's going from Citadel to Millennium, and he's been gardening for 9 months because he can't physically work because they have these non-compete agreements. So when you actually ask these portfolio managers, what do you care about in terms of, deciding which multi-manager you want to work at. I found this super interesting. They really care about the culture and working environment, which I don't know. They don't really care about, the structure, the resources, the brand. They care about who they're working with, because I guess they have the pick of the litter, and they get to decide the best culture. So when you ask allocators, what is the best things about multi-manager funds? They say the low volatility, the diversification. You can see they're not that thrilled with the level of returns, right? Because 8% returns, that's really good. I mean, that's pretty good. But it's like there's funds out there, private equity firms that return 30% IRR, right? And obviously that's also really good. But that's way more risky. So on a risk return basis, on that plane, again, this one would be further on the left, which is better. And when you say what are the disadvantages, these multi-managers know that they're the hot commodity right now. Every allocator wants to allocate some percentage of their money to these multi-managers because they're so diversified. And so you can see that, their leverage, their level of fees, their transparency, increasing illiquidity, pass-through structures, these are all things that Citadel or Millennium are deciding. They're saying like, okay, once you give us your money, you can't take it back for 5 years. Once you give us your money, if you need it back, you have to tell us 2 years in advance. They're making all these terms because it's better for them, it's better for their PMs, and it's worse for LPs. So LPs are getting frustrated with this. And like George had mentioned, the risk management is entirely centralized. So there's this phenomenon known as platform degrossing, which is, you're a PM, you have a team of 2 analysts, you're working at Citadel, you have a bunch of positions open. You might go to bed one day and, hoping your positions will increase. Next morning you wake up and all your positions are liquidated, right? That's incredibly frustrating if you had some thesis that's going to take 5 years to play out. The multi-managers don't really care about that. If you're down 1%, you get a call. If you're down 10%, you're fired. Your whole team is gone, right? And that's why these places are sometimes referred to as chop shops, because job security is extremely low. Because if you have one bad month, one bad year, one bad day, maybe you get fired. And degrossing is what happens when there's a lot of volatility in the markets. The people who run Citadel's risk management team are very nervous. They think, okay, let's just close down all of our funds. Let's not sustain any losses. They hit the big red button. Every position gets liquidated. And obviously some PMs are annoyed. But when you look at the downside in certain crises, right? So in the 2020 COVID crisis, multi-managers only lost 0.8%, right? The average hedge fund lost 7.3%, and the equity market lost 20%. And you can see in all of these cases, multi-managers are losing or sometimes even making money when the market crashes. And this is another big benefit of the centralized risk management, is that one person suddenly has the discretion to say, hey, let's just not take any risk here. Let's just stay out of the market, and that can happen. Okay, that's pretty much our lecture. Any questions? Yes?
Let's say you do really bad for a day or a month and you get fired. Does that have any bearing on your future career and prospects? Like, are you screwed for the industry?
That's a great question. So it's pretty common for pod shop professionals to get fired. So you could move from Millennium to Citadel, even though you just got fired from your last job. Yeah.
And it's an interesting case. That's why a lot of people are very nervous about taking these jobs. They'd much rather work at a secure single manager. And that's why, if you were in our first lecture, we talked about the golden path. That golden path, really, in terms of, when I have a wife and kids, do I really want to be worried about, am I going to lose my job tomorrow? That's why people prefer to work in those types of environments. But the incentives and the fees and the money you make at these pod shops is a lot higher than what you would make working as a single manager. 2 last things before I take the last questions. Tiger Investments, Thursday open education session. Really great. They cover everything covered in lecture 2 over a much longer time frame. Interest link is there, and it's Thursdays 8:30 to 9:30. I don't know exactly how much you're in. And please, before you go, fill out this survey. Give us ideas for the last lecture. You can rate us, tell us what we did good, tell us what we did bad. And yeah. Okay, yeah, last question. Anyone else?
What does an endowment count as? Are they multi-manager?
An endowment is an allocator. So
An LP.
an LP, yeah. Because endowments, yeah, maybe they have someone who buy stocks directly under the endowment. But for the most part, allocators are people who give money to other people to manage, and that's what an endowment primarily does.
In our first lecture, we actually showed you Princeton's endowment allocator.
Yeah.
So if you could go back to that.